A housing bubble occurs when home prices surge at an unsustainable rate, fueled by speculation and unsustainable market conditions. This rapid price growth often detaches from the underlying economic fundamentals, such as income levels and affordability. Imagine a balloon being inflated beyond its capacity. Eventually, it will burst. Similarly, a housing bubble is characterized by a disconnect between prices and real value, leading to an eventual correction where prices plummet, often abruptly. This correction can have devastating consequences for homeowners, investors, and the overall economy. Understanding the dynamics of housing bubbles is crucial for making informed decisions in the real estate market. By recognizing the factors that contribute to these bubbles, we can better assess the current state of the market and identify potential risks. The interplay of supply and demand plays a critical role in the formation of housing bubbles. When demand outpaces supply, prices naturally rise. However, in a bubble scenario, this demand is often driven by speculative buying rather than genuine housing needs. Investors and homebuyers alike rush to enter the market, hoping to capitalize on the rapid price appreciation. This speculative frenzy further inflates the bubble, creating a self-perpetuating cycle of unsustainable growth. The U.S. housing market in 2024 presents a complex picture. It's a landscape marked by a series of contrasting elements that together create a challenging environment for both buyers and sellers. We are experiencing a period of historically low mortgage rates, which has made borrowing more affordable and fueled demand. These low rates have been a significant driver, encouraging many to take the plunge into homeownership or to refinance their existing mortgages. At the same time, the inventory of homes for sale remains stubbornly low, further intensifying competition among buyers. This scarcity of available homes has created a seller's market, where bidding wars have become increasingly common, and homes often sell for well above their asking prices. This combination of factors has driven up home prices at an alarming rate in many parts of the country. Buyers are finding themselves in a race against time, trying to secure a home before prices climb even higher. According to the National Association of Realtors, the median existing home price in June 2024 reached a new high, reflecting the strong demand and limited supply. This surge in prices is not just a statistic, it represents real challenges for those looking to buy a home. While low mortgage rates have made monthly payments more manageable for some, the rapid price appreciation has raised concerns about affordability. Many families are finding that even with favorable loan terms, the overall cost of purchasing a home is becoming increasingly out of reach. Many potential homebuyers, particularly first-time buyers, are finding themselves priced out of the market. The dream of owning a home is slipping away for many, as they struggle to save for down payments that keep growing larger. This situation has led to a growing debate among economists and real estate experts. Is the U.S. housing market heading towards another bubble? The question is complex, with opinions divided on whether the current trends are sustainable or if they signal impending trouble. Some argue that the current conditions are reminiscent of the period leading up to the 2008 financial crisis, pointing to the rapid price increases and the high levels of debt being taken on by buyers, while others maintain that the market is fundamentally different this time around. They cite stricter lending standards, better economic fundamentals, and a more regulated financial system as key differences that could prevent a repeat of the past. Understanding the factors driving the current market is crucial for assessing the likelihood of a bubble. It's important to consider not just the numbers, but the broader economic context, including employment rates, wage growth, and consumer confidence. For potential buyers, staying informed and seeking professional advice can make a significant difference. Navigating this complex market requires careful planning and a clear understanding of one's financial situation. Despite the challenges, many are still finding success in the housing market. With the right approach and a bit of patience, the dream of homeownership can still become a reality. As we move forward, the dynamics of the housing market will continue to evolve. Keeping a close eye on trends and being prepared to adapt will be key for anyone looking to buy or sell a home in the coming years. Several key factors are contributing to the current state of the U.S. housing market. Understanding these factors can help us grasp the complexities and dynamics at play. One significant factor is the historically low mortgage rates that have prevailed in recent years. These low rates have made borrowing cheaper, encouraging more people to take out loans for home purchases. The Federal Reserve's policies aimed at stimulating the economy during the COVID-19 pandemic led to these low rates. By lowering interest rates, the Fed hoped to boost economic activity and support recovery during a time of unprecedented uncertainty. While these low rates have made homeownership more accessible to some, they have also increased demand and contributed to rising prices. More buyers in the market mean more competition for available homes, driving prices up. Another critical factor is the severe shortage of housing inventory. The supply of homes has not kept pace with the growing demand, creating a significant imbalance. The U.S. has been underbuilding for several years, resulting in a significant gap between the number of homes available and the number of people who want to buy them. This shortage is partly due to regulatory hurdles, labor shortages, and rising construction costs. This supply-demand imbalance is a major driver of price increases. When there are more buyers than available homes, bidding wars become common, pushing prices even higher. Furthermore, the pandemic has led to shifts in housing preferences, with many seeking larger homes or homes in different locations, further straining inventory. Remote work has allowed people to move away from city centers to suburban or rural areas, increasing demand in those regions. Adding to the complexity is the role of institutional investors in the housing market. These investors, often large corporations, have been purchasing significant numbers of homes, particularly in certain markets. These investors, often large corporations, have been purchasing significant numbers of homes, particularly in certain markets. Their buying power can outcompete individual buyers, making it harder for average families to secure a home. While their presence can provide liquidity, it also raises concerns about affordability and competition for individual homebuyers. The increased competition from these investors can drive prices up even further, making it challenging for first-time buyers to enter the market. The combination of these factors has created a highly competitive market that favors sellers. With more buyers than available homes, sellers often receive multiple offers, sometimes above the asking price, leading to a seller's market. As we look ahead, understanding these dynamics is crucial for anyone looking to buy or sell a home. Staying informed about market trends, interest rates, and inventory levels can help navigate this complex landscape. The housing market is influenced by a myriad of factors, and staying updated on these can provide valuable insights. Whether you're a first-time buyer, a seasoned investor, or simply curious about the market, knowledge is key to making informed decisions. In conclusion, the current state of the U.S. housing market is shaped by low mortgage rates, a shortage of inventory, changing housing preferences, and the influence of institutional investors. Each of these elements plays a significant role in driving the trends we see today. By understanding these factors, we can better navigate the challenges and opportunities within the housing market. Whether you're buying, selling, or investing, staying informed is essential for success. The current housing market, while robust, exhibits certain characteristics reminiscent of past bubbles. The bustling streets lined with for sale signs and the rapid turnover of properties are eerily similar to the prelude of previous housing crises. One of the most concerning signs is the rapid pace of home price appreciation. In many urban and suburban areas, the skyline is dotted with cranes and new construction projects, signaling a booming market. However, this boom comes with its own set of challenges. In many markets, prices have been rising at double-digit rates year over year, far outstripping wage growth and inflation. This disparity creates a significant gap between what people earn and what they need to spend to own a home. This disconnect between housing costs and income growth is unsustainable and raises concerns about affordability. Families are finding it increasingly difficult to keep up with the rising costs, leading to financial strain and anxiety. Another red flag is the increasing prevalence of risky lending practices. Although lending standards have improved since the 2008 crisis, there are still instances where lenders are willing to take on higher risks to capitalize on the strong demand for mortgages. While lending standards are tighter than they were in the lead-up to the 2008 crisis, there are signs that some lenders are loosening requirements to meet the strong demand for mortgages. This includes offering loans with lower down payments and longer repayment terms. This could lead to a situation where borrowers take on more debt than they can handle, potentially setting the stage for another wave of foreclosures if the market were to cool down. The sight of foreclosure signs and eviction notices could become all too common once again. Furthermore, the level of speculation in the market is a cause for concern. Investors are flocking to property auctions and open houses, hoping to make a quick profit by flipping homes. Anecdotal evidence suggests that some buyers are purchasing homes with the sole intention of flipping them quickly for a profit, rather than for long-term occupancy. This speculative behavior can drive prices up even further, creating a volatile market. This type of speculative buying can inflate prices and create artificial demand, leading to an unstable market. The rapid turnover of properties and the constant bidding wars are signs of a market that may be overheating. While these warning signs do not necessarily guarantee a bubble, they warrant caution and careful monitoring. Economists and market analysts are keeping a close eye on these trends, hoping to prevent another catastrophic collapse. Homeowners and potential buyers should stay informed and be prepared for possible market corrections.